Welcome to the Deep Dive. This is where we cut through all the noise, really distill the key insights, and get you right to the heart of what's actually happening. Today, we're doing something pretty fascinating. We're taking a look at a really unique source. It's an AI-generated market news summary. Our mission is to pull out the most important nuggets of knowledge about global financial markets for you. We want you to get quickly up to speed on currencies, equities, macro indicators, all viewed through this, interesting lens of an AI-curated overview.
That's right. And for this deep dive, we're looking specifically at the script from something called AI Market News by LM, which we found presented through various news commentary sources. It's quite a compelling example, actually, of how AI is being used to synthesize, complex market info into something more digestible. Now, as is often the case with this kind of content, it starts with a disclaimer. And, since we're reviewing the source material thoroughly, we should probably acknowledge it. The summary we looked at included this text right at the start. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Okay, right. So with that disclaimer noted, let's unpack this AI summary and see what really jumps out for us to dig into. We absolutely have to start with U.S. equities. I mean, what a run they've been on. The S&P 500 has just been on fire, hasn't it? Hitting record highs. It got to an all-time high, 6,508.23 back in August, closed at 6,502.08 yesterday, September 4th, 2025. And now is hovering around 6,049.99. That's a pretty remarkable 9.84% gain just this year, and Nasdaq's seen big gains too. So the big question is, what's actually driving this rally that just seems unstoppable?
What's really insightful from the prepared resources is how this rally is primarily fueled by something of a paradox, actually. It's expectations of a cooling U.S. labor market combined with this near certainty, it seems, of a Federal Reserve rate cut in September. So the market's essentially taking weak economic news as good news. Why? Because it strengthens the argument for lower rates.
Right, the classic bad news is good news scenario.
Exactly. And while that might seem a bit counterintuitive, it is a classic pattern we see. But the AI summary kind of implicitly highlights the fragility here. How sustainable is a rally that's built on this idea if that economic cooling actually turns into something, more severe? That could challenge corporate earnings, not just interest rate policy.
That is a really critical distinction. And speaking of that cooling labor market, all eyes are glued to the jobs data that's coming out today, right? Friday, September 5th. The market's expecting non-farm payrolls, I think around 75,000 for August.
Yeah, 75,000.
Which would be the lowest estimate since, December 2020? And if you take out the COVID period, you have to go way back, maybe 2011, to see numbers that low consistently.
It's a significant drop-off, yeah.
And the unemployment rate is also expected to tick up a little to 4.3% in August. We're also watching average hourly earnings forecast is 0.3% month over month, 3.7% year over year, and average weekly hours at 34.3.
Indeed. And the input sources really highlight that recent weaker data points like a rise in the JOLTS layoffs data, a miss on the ADP private payrolls report, have actually paradoxically spurred this equity rally. Initial jobless claims have also been creeping higher, hitting levels we haven't seen since June. Now, this whole situation brings up a really important question for us. If the market's relying so heavily on these rate cut hopes, what happens if the jobs numbers, don't cool off enough? Or maybe even worse, what if they cool off too much, signaling a deeper economic contraction that starts hitting company revenues, not just their financing costs?
Yeah, that's the balancing act.
Right. And the AI summary, it just presents these facts objectively, no judgment. But it's really up to us to consider these deeper vulnerabilities.
And just to add another layer of complexity here, various news commentary also touches on the political backdrop swirling around the Federal Reserve. We saw Stephen Miron, who's nominated for the Fed Board of Governors, facing some pretty intense questioning during his confirmation hearing. Questions about his independence, especially his plan to keep his White House job, albeit on unpaid leave if he's confirmed. That raised some eyebrows.
It certainly did.
And then there's the separate issue, the Justice Department's criminal investigation into Lisa Cook, another Fed official, over alleged mortgage fraud. These are significant headlines, and they introduce a whole different kind of uncertainty into the mix.
They absolutely do. These events really emphasize that the whole idea of Fed independence is, it's being actively debated right now. You have some corners really raising concerns about its potential undermining, The sources we looked at even mentioned an Australian pension fund, citing concerns about U.S. politics and policy outlooks as a reason for being underweight treasuries.
Wow.
So this is critical for market credibility, particularly for the U.S. dollar. If the Fed's perceived impartiality starts to erode, that could trigger a much broader questioning of U.S. financial stability. You could potentially see capital flight, maybe significant currency devaluation beyond what we're already seeing, just from rate cut expectations alone.
Okay, so let's shift focus now from equities and the Fed drama. Let's look at global currency pairs. We're seeing a generally weaker U.S. dollar, as you mentioned, and that's definitely shaking things up in the Forex markets. How are the other majors reacting?
Well, what's quite fascinating here is how the dollar's weakness is giving pretty significant support to the euro. And this is happening even though Europe itself is, grappling with its own growth concerns.
Right.
According to CFTC data, speculative net positions for the euro are significantly long, about 123,000 contracts, which, for anyone less familiar, a strong long bias like that means a lot of speculative traders are betting the euro will go up against the dollar.
Okay, and what about the yen?
The yen's shown a bit of firmness recently, notably after Japan's labor cash earnings came in stronger than expected, 4.1% for July. That potentially strengthens the case for the Bank of Japan to maybe hike rates. However, overall, the yen is still broadly weak. The average forecast seems to be around 140 against the dollar, compared to where it is now, about 148.5. Interestingly, CFTC JPY speculative net positions also show a strong long bias at 84,500. So traders are expecting a stronger yen eventually, despite where it sits right now.
Okay, interesting dynamics there. Now let's pivot to commodities. We're seeing some divergence, aren't we? Gold prices are climbing, getting near record highs, but oil is actually falling. What do these contrasting moves tell us about market sentiment and the outlook for raw materials?
Yeah, the commodity trends are quite telling. Gold's strength is partly driven by those Fed easing expectations we talked about. Plus, broader market uncertainty often drives investors towards traditional safe havens like gold. It's a classic hedge.
Makes sense.
For oil, though, we're seeing softness. U.S. crude inventories rose by 2.4 million barrels in August, and the market is definitely on edge ahead of the OPEC Plus meeting this weekend. There's talk they could announce another supply hike.
Right.
Some analysts are even predicting a potential supply glut in 2026. Goldman Sachs, for instance, forecasting prices possibly down in the low $50 range.
Wow. Low $50.
If that happens, it would put even more downward pressure on prices. Good for consumers, maybe, but signals concerns about global demand and obviously impacts producers.
Okay, let's pivot again, this time to some big corporate news, especially in tech. That sector just keeps driving so much activity and innovation. What stood out in the AI summary there?
A really major development highlighted in the prepared resources involves Broadcom. Its stock jumped quite a bit on reports of over $10 billion in orders from OpenAI. $10 billion, yeah, for AI accelerator chips. The first ones are expected to ship next year. Now, this is a really significant strategic move for OpenAI, designing its own chips. It's a direct challenge to NVIDIA's dominance in this, incredibly lucrative area.
Absolutely.
Broadcom's AI chip revenue is now forecast to hit something like $6.2 billion. But beyond the numbers, what this really tells us is about this growing trend towards vertical integration in AI. Companies like OpenAI, they want more control over their hardware.
Right.
And that could fundamentally reshape the competitive landscape for chip makers, moving beyond just a few big players.
Yeah, diversifying the hardware base.
Exactly. It signals the maturity and strategic importance of AI infrastructure.
That is a huge development. And this focus on tech and sort of domestic production seems to extend to trade policy, too. President Trump recently hosted this dinner with a real who's who of tech leaders, Sam Altman, Mark Zuckerberg, heads of Microsoft, Alphabet. And he reportedly secured pledges for pretty substantial U.S. investment. I think Mark Zuckerberg mentioned something like $600 billion through 2028 in the U.S.
That was the figure mentioned, yeah, $600 billion. It's not just about chips. It's about that broader tech ecosystem and clearly a national economic strategy.
Right.
And it also ties into a newly signed trade deal with Japan. President Trump signed an executive order to implement it. It notably caps tariffs on most Japanese imports, including cars and parts, at a maximum of 15%. And crucially, it prevents that stacking of duties, which was a huge worry for manufacturers.
Okay.
This directive, effective within 4 to 7 days apparently, is a big relief for Japanese automakers, gives them predictability. And in return, Japan also pledged a substantial $550 billion investment fund for the U.S., though the specific details on that fund are still kind of emerging. But it illustrates this trend of complex reciprocal agreements trying to influence global supply chains and investment flows.
Meanwhile, over in China, we're seeing their tech ambitions continue to grow, alongside some interesting market curves domestically. DeepSeek is reportedly developing an advanced AI model aiming to rival U.S. competitors, maybe unveiling it in the fourth quarter.
That's the report, yeah.
And at the same time, Chinese regulators are apparently considering curbs on stock market speculation. This follows strong buying and record borrowing margin financing hitting levels similar to the 2015 crackdown, apparently.
Yeah, connecting those dots on global tech competition. The sources really imply this strong drive from China for self-sufficiency and innovation, particularly in AI and chips. And this push is likely spurred, at least in part, by ongoing U.S. export curbs.
Right.
So it raises this important question: how will this accelerating competition, this race for technological independence, how will it reshape the global tech landscape? In terms of innovation, market dominance, we might be seeing a kind of bifurcation, each major power aiming to control its own destiny in critical tech, potentially leading to parallel ecosystems instead of one truly global, interconnected one.
Fascinating and maybe a bit concerning. Okay, let's broaden the view one more time to other global economic and political developments. The world stage always provides crucial context for the markets. What else stood out from the AI summary in terms of global hotspots?
Certainly. Well, one key development from a European perspective is France. It's facing a new political crisis. There's an upcoming confidence vote, and it's widely expected to cause the government to collapse.
Oh, wow.
Now, while it's currently seen more as a political crisis, not yet a debt crisis, that increasing uncertainty could definitely weigh on domestic demand there. It could potentially impact consumer confidence, investment within the Eurozone, which sort of connects back to our earlier discussion about the Euro's strength, despite these issues.
Interesting connection.
Yeah. Then, further east, in Turkey, the central bank governor is staying optimistic about tackling inflation, even though the latest data was worse than expected. He's citing, underlying trends and GDP components as signs that demand pressure is easing. But that optimism contrasts with the hard data, which is often a challenge in emerging markets.
Sure.
And shifting north, the Danish central bank looks set to substantially cut its 2025 economic outlook. This is mostly due to weaker sales growth at Novo Nordisk, a big pharmaceutical company, and also the wider impact of global tariffs. It really highlights how just one major company, especially one with a global footprint like Novo Nordisk, can significantly sway the forecast for a smaller open economy.
It really is fascinating how these seemingly separate events you pull from various news commentary, a political crisis in France, a pharma giant's sales in Denmark, are all interconnected. They create this incredibly complex global economic picture that everyone, investors, policymakers, has to navigate. Shows how macro factors ripple right down to specific sectors, even individual companies.
Absolutely.
Okay, let's bring it back finally to investor sentiment. That always gives us a good pulse check on the market's mood. The summary we looked at referenced the Fear and Greed Index, that CNN tool for gauging market emotions. What does that index tell us about how investors are feeling right now?
Yeah, the Fear and Greed Index is a pretty powerful tool because it boils down a lot of complex information into one sort of intuitive score. It uses several broad categories of market signals to gauge investor psychology, things like market momentum, stock price strength, market breadth, also options activity, overall market volatility, even demand for safe havens versus junk bonds.
All right, it covers a lot.
It really does. By combining all these, it aims to score sentiment from 0, which is extreme fear, up to 100, representing extreme greed. And the current sentiment, as noted in the prepared resources, indicates strong bullish momentum. It's leaning towards the greed side of the scale.
Okay, so still quite positive despite the uncertainties.
It suggests a pretty widespread positive outlook, yeah, despite some of those underlying economic questions we've been discussing.
All right, good to know. And just to help you plan your day and stay ahead, let's quickly run through the upcoming economic schedule for today, Friday, September 5th, 2025. This is according to investing.com's calendar.
Sure. We've already had a flurry of data earlier today. We saw the coincident indicator and leading index from Japan, retail sales from Singapore and the UK. So German factory orders, the French trade balance, Italian retail sales, and those Eurozone employment and GDP figures.
Right, a busy morning already.
Definitely. But the really big events, the ones on everyone's radar for the US, are the non-farm payrolls again, expected at 75,000. average hourly earnings, forecast at 0.3% month over month, and that unemployment rate expected to tick up to 4.3%. Those are all due out at 8:30 a.m. U.S. Eastern Time, right alongside Canadian employment data.
Okay, key time to watch.
Absolutely. And then later today, we get the U.S. Baker Hughes rig counts at 1:00 p.m. U.S. Eastern Time. So these are the numbers that will really continue to shape market reactions as the day unfolds, and everyone will be watching closely for more clues about the Fed's likely path.
We have certainly taken a deep dive today. We've gone from the S&P's record highs and that really intricate dance between jobs data and Fed expectations, all the way to seismic shifts in AI chip manufacturing, and this complex web of global political and economic developments. And all of this viewed through the, well, unique lens of an AI-generated market news summary.
Indeed. And this deep dive into an AI-generated summary, it really raises an important question for you, the listener, to consider. In a world where artificial intelligence is evolving so rapidly, where summaries and analyses are increasingly automated, how do we as informed decision makers keep cultivating our own critical thinking, our uniquely human insights, especially when we're making critical investment decisions? Where does our unique analytical value truly lie in this new landscape? Something to think about.
That's a great closing thought. Thank you for joining us on this deep dive. We really hope this has given you a clearer, maybe more nuanced understanding of today's complex global markets, and perhaps how looking at AI-curated information can spark even deeper questions.